If you woke up this morning and checked the markets, you witnessed something the financial establishment swore would never happen. At 3:47 a.m. Eastern Time, the Japanese 40-year government bond yield crossed 4% for the first time since that maturity was created in 2007. While you were sleeping, an entire financial paradigm collapsed. This is not a drill. This is not a simulation. This is the beginning of something the mainstream has been hiding from you for years. CNBC will not tell you what this means. Bloomberg will minimize it as a technical adjustment. The Wall Street Journal will bury it below the fold. Fox Business will talk about something else entirely. They have to. Because if they told you the truth, if they admitted what just happened, they would be forced to acknowledge that everything they have told you for the past decade was catastrophically wrong. And that admission would cost them their credibility, their advertisers, and their place in a system that rewards comforting lies over uncomfortable truths. But I am going to tell you. I am going to show you the numbers they are hiding. I am going to connect the dots they are desperately trying to keep separated. And by the end of this, you will understand why gold just hit $4,120 an ounce, why the trade they mocked is crushing everything, and why the window to protect yourself is closing faster than you think. This is not entertainment. This is your financial survival. Before we go any further, I need you to do something. Hit the subscribe button and click that notification bell right now. Not for me. For you. Because the algorithm is designed to suppress exactly this kind of information. The system does not want you to see this. Every subscription, every like, every share is an act of resistance against a financial media complex that has lied to you for years. Do it now. We do not have much time. The people who control what you see online have a vested interest in keeping you ignorant. Do not let them win. Let me take you back to a CNBC interview from years ago. A man named Bill Fleckenstein sat across from the host and made two simple predictions. First, he said Japan would probably be the first bond market to blow up. Second, he said he was buying gold and gold miners. Do you know what the CNBC host said to him? They laughed. They smirked at each other. One of them literally said, and I quote, "But Bill, it sounds like you missed a lot. A lot of this sounds kind of pathetic." Pathetic. That was the word they used. Pathetic. Gold has risen 184% since then. Japanese bonds are now in full collapse. And those same hosts? Silent. Nowhere to be found. No apologies, no retractions. No segments saying they were wrong, just silence. Deafening, cowardly silence. This is not an accident. This is how the system works. The financial media exists to protect the status quo. They exist to make you feel safe holding assets that are being systematically devalued. They exist to ridicule anyone who points out that the emperor has no clothes. They called Bill Fleckenstein pathetic for being right. They will call you pathetic too if you dare to protect yourself. Let them. History will show who was pathetic and who was prescient. Let me explain what is actually happening in Japan, because once you understand this, everything else falls into place. This is not complicated. The math is simple, but the implications are enormous. Japan has the highest debt-to-GDP ratio in the developed world. Not by a little, by a lot. We are talking 250%. Let me put that in perspective. The United States, which everyone agrees has a debt problem, has a debt-to-GDP ratio of 120%. Japan is more than double that. The total Japanese government debt stands at 1,341.7 trillion yen. That is $9 trillion. $9 trillion. Let me do the math for you so you can feel the weight of this number. If you stacked $9 trillion in $100 bills, it would reach approximately 6,100 miles high. That is enough to go from the Earth to beyond the orbit of the International Space Station and back. 24 times. For years, decades actually, the Bank of Japan kept this house of cards standing through a policy called yield curve control. Here is how it worked. The BOJ would buy unlimited amounts of government bonds to keep the 10-year yield pinned near zero. It did not matter what the market wanted. It did not matter what inflation was doing. It did not matter that the math was impossible. The BOJ would simply print yen and buy bonds until yields stayed where they wanted them. They were the bid. They were the market. They were everything. This created an illusion. The illusion that Japanese government debt was safe. The illusion that yields would stay low forever. The illusion that the BOJ was in control. The illusion that central banks could override the laws of mathematics indefinitely. And for a while, it worked. For a while, anyone who questioned it looked foolish. For a while, Bill Fleckenstein sounded pathetic. In March 2024, that illusion died. The Bank of Japan officially abandoned yield curve control. They had no choice. Inflation had risen to 3%, well above their 2% target. They could not keep printing without destroying the yen entirely, so they stepped back. They said they would still participate in the market, but they would no longer guarantee any specific yield level. They admitted, without saying the words, that they had lost control. And then the real price discovery began. Since March 2024, the 10-year Japanese government bond yield has tripled. Let me say that again. Tripled. From 0.75% to 2.38%. And this morning, the 40-year yield hit 4% for the first time ever. The 20-year yield jumped 22 basis points in a single day to 3.47%. The 30-year yield is at levels not seen in decades. These are not normal moves. These are not technical adjustments. These are not temporary fluctuations. This is a market screaming that something is fundamentally broken. This is a market telling you that the promises made by central bankers were lies. But it gets worse. Much worse. On January 19th, Prime Minister Sanai Takaichi announced she would dissolve Parliament and call snap elections for February 8th. Her campaign promise? To cut the sales tax on food to 0%. Sounds great, right? Free money, lower prices. What could go wrong? Here is what could go wrong. How will she pay for it? She did not say. Not a word, not a hint. Bond investors did the math and ran for the exits, because they understood what the average voter does not. There is no free lunch. Someone always pays. And when the government cannot explain how it will fund its promises, the bond market assumes the answer is money printing. Since Takaichi took office in October, the 20-year and 40-year yields have risen about 80 basis points. 80 basis points in less than 4 months on top of yields that were already at multi-decade highs. The government just approved a record $780 billion budget for fiscal year 2026. More spending, more debt, higher yields, higher interest payments, which require more debt, which raise yields further. The death spiral is accelerating, and no one in power seems willing or able to stop it. Here is the mathematics that the BOJ cannot escape. Let me walk you through this calculation because it is the key to understanding why the situation has no good outcome. Japan has $9 trillion in debt. If the average interest rate on that debt rises by just 1%, the government owes an additional $90 billion per year in interest. That is $90 billion that cannot be spent on anything else. That is $90 billion that either comes from tax increases, spending cuts, or more borrowing. If it comes from more borrowing, it adds to the debt, which adds to the interest payments, which requires more borrowing. Do you see the trap? Every 1% increase in average yields adds trillions of yen to the government's annual interest payments. With debt at $9 trillion and yields rising, the interest expense alone starts consuming larger and larger portions of the budget. It is a trap. If they raise rates to fight inflation, they bankrupt the government. If they keep rates low, they destroy the currency. There is no exit. There is no good option. There is only the choice between two different flavors of collapse. The Bank of Japan has already cut $502 billion from its balance sheet since the peak. Let me put that in context. The BOJ is engaging in what is called quantitative tightening. They are reducing their holdings of Japanese government bonds. They are stepping away from the market. This is not strength. This is capitulation. They are admitting they cannot hold the line anymore. Total BOJ assets are now at 677.8 trillion yen, the lowest level since the second quarter of 2020, down 10.4% from the peak. The most powerful bond buyer in the history of financial markets is retreating, and yields are still exploding higher. If the BOJ could not control yields when it was buying everything in sight, what happens when it is actively selling? Now here's where this becomes your problem, because you might be thinking, Japan is far away. Japan is different. Japan's problems are Japan's problems. That is exactly what they want you to think. That is the story they are telling you so you do not panic. But the truth is, Japan's problems are everyone's problems. Japan is the largest foreign holder of United States Treasury securities. As of November 2025, Japanese entities held $1.2 trillion in American government debt. $1.2 trillion. Let me help you visualize that. If you spent $1 million every single day, it would take you over 3,200 years to spend $1.2 trillion. That is how much Japanese money is sitting in American bonds. The United Kingdom is second with $88 billion yields. China is third, but Japan is first. Think about what happens when Japanese yields rise. Japanese investors, whether they are pension funds, insurance companies, or banks, can now earn higher returns at home without currency risk. Why would they buy American bonds yielding 4.3% when they can buy Japanese bonds yielding 4% in their own currency with no hedging costs? The math does not work anymore. For years, Japanese investors bought American bonds because their own bonds paid nothing. Now their own bonds pay something. The incentive to own American debt has fundamentally changed. If Japanese investors start repatriating funds, if they start selling treasuries to buy JGBs, who fills that gap? Who becomes the marginal buyer of American debt? The answer is either the Federal Reserve, which means more money printing, which means more inflation, which means higher gold prices, or yields go up, which means higher mortgage rates, higher corporate borrowing costs, higher credit card rates, higher everything. Your cost of living goes up. Your purchasing power goes down. Either way, you lose if you are not prepared. This is already happening. On the same day, Japanese 40-year yields hit 4%. The U.S. 30-year Treasury yield rose 10 basis points to 4.94%. The 10-year hit 4.30%, the highest since September 3rd. Japanese bonds sneeze and American bonds catch a cold. This is not theory. This is not speculation. This is happening in real time, on your screens right now. European countries hold $8 trillion in U.S. bonds and equities. $8 trillion. Twice as much as the rest of the world combined. And right now, there are additional tensions between Europe and the United States over Greenland. Denmark substantially increased its military presence after Trump refused to rule out using force to secure control of the island. Trump is threatening an additional 10% tariff on 8 European countries starting February 1st, potentially rising to 25% in June. What happens if Europe decides American assets are not worth the political risk? What happens if the goodwill that has kept foreign money flowing into American markets evaporates? What happens if everyone tries to exit at once? Who buys the debt? Who funds the deficit? Who maintains the illusion? While all of this is happening, gold hit $4,920 an ounce, a new all-time record. It rose 63% in 2025 alone. Think about that, 63% in 1 year. It is up 184% since the end of 2019. It has gained 6% just in January. Every single day, gold is telling you something. Every single day, gold is screaming that the system is breaking, and every single day, the financial media tells you to ignore it. Let me ask you some questions. When the 40-year Japanese bond yield hits a record high, where does the money go? When the largest foreign holder of U.S. Treasuries stops buying, where does the money go? When central banks around the world are losing control of their bond markets, where does the money go? When fiat currencies are being printed into oblivion, where does the money go? When the same experts who called gold investors pathetic are now silently watching their predictions collapse, where does the money go? When every major government is running deficits that cannot be sustained, where does the money go? When trust in institutions is collapsing, where does the money go? You already know the answer. Gold. JP Morgan expects gold to push toward $5,000 an ounce by the fourth quarter of 2026. They see $6,000 as possible longer term. These are not gold bugs. These are not fringe commentators. This is JP Morgan, one of the largest banks in the world. Ned Naylor Leyland of Jupiter Asset Management said it was, quote, absolutely possible for gold to touch $5,000 this year. The World Gold Council projects gold could surge 15% to 30% in 2026 under certain scenarios. The people who were right are getting more bullish. The people who were wrong are getting quieter. Pay attention to who is talking and who is silent. Silence tells you everything. Let me show you the mathematics of this trade. On January 12, 2026, gold hit its first record high of the year above $4,600. On January 13th, it hit another record above that level after news broke that Jerome Powell, the chair of the Federal Reserve, is under criminal investigation relating to a $2.5 billion renovation of the Fed's headquarters. On January 19th, it hit $4,690. On January 20th, it crossed $4,520. 4 records in 8 days. This is not random. This is not noise. This is a market that is waking up to what the bond market in Japan just confirmed. Central banks are losing control. The debt is unpayable. The only asset without counterparty risk is physical gold. The only asset that cannot be printed is gold. The only asset that has been money for 5,000 years is gold. Here's what happens next. I am going to walk you through the timeline so you know exactly what to watch for. In the next 7 days, volatility in Japanese government bonds will continue. The 10-year yield will test 2.5%. Gold will consolidate above $4,700 and test $4,800. The BOJ may attempt verbal intervention or emergency measures. CNBC will try to convince you this is contained. They will bring out experts to explain why this is not a crisis. They will use words like adjustment, repricing, normalization. It is not contained. It is not normal. It is the beginning. In the next 30 days, Japanese elections will take place on February 8th. This is the key event. If Takaichi wins with a larger majority, yields will spike further because the market will price in more fiscal expansion. The yen carry trade, one of the largest leveraged trades in the world, will begin to unwind. For years, investors borrowed cheap yen to buy higher-yielding assets elsewhere. When the yen stops being cheap, that trade reverses. Japanese investors will repatriate funds. The trickle becomes a flood. Gold will approach $5,000. Global volatility will increase significantly. In the next 90 days, the new Japanese government will present an expansionary budget. The BOJ will be forced to make an impossible choice between fighting inflation and preventing fiscal collapse. They cannot do both. One or the other will break. The first wave of potential credit downgrades will arrive. Ratings agencies will finally acknowledge what the market already knows. The yen will test 160 per dollar or beyond. Gold will consolidate between $5,000 and $5,500. Other developed market bond markets will show stress. The contagion will spread. Beyond 90 days, a new paradigm of higher yields establishes itself. The era of zero interest rates is over. The era of central bank omnipotence is over. Gold as a reserve asset gains mainstream acceptance. The same institutions that mocked gold will quietly accumulate it. Central banks lose their credibility as market controllers. Investors who waited will pay a massive premium. Those positioned in physical gold will have preserved their purchasing power. The impossible becomes the new normal, and everyone will pretend they saw it coming. Now let me talk directly to you, not to the markets, not to the institutions, not to the abstractions. To you sitting there, watching this, where do you fit in this picture? Fit. Where are your savings right now? If the answer is a bank account, you are losing purchasing power every single day. Let me do the math. In 2019, $10,000 could buy you approximately 6 ounces of gold. Gold was around maybe $500 per ounce. Today, that same $10,000 buys you about 2.1 ounces. Your $10,000 did not grow. It shrank. In real terms, measured against the oldest money in human history, your savings lost 65% of their value. If you wait until gold hits $5,000, that $10,000 will buy you 2 ounces. If you wait until $6,000, it buys you 1.7 ounces. Every day you wait, your money buys less real wealth. This is not theory. This is arithmetic. If you own bonds, you are holding the same asset class that is collapsing in Japan. When yields rise, bond prices fall. That is not opinion. That is mathematical fact. A bond is a promise to pay you back with interest. When new bonds offer higher interest, your old bonds become less valuable. That 60-40 portfolio your financial advisor told you was safe? The 40 is underwater. The safe haven is sinking. Your financial advisor is not going to tell you this because their job depends on you staying in the system. If you own bond ETFs, you own paper. You own a promise that someone else has the real thing. You do not own the real thing. In a crisis, promises evaporate. Ask the depositors in Cyprus in 2013 how quickly their bank accounts became a source of government funding. One weekend they had money. The next Monday, the government took a percentage to bail out the banks. That is what happens when systems fail. The rules change overnight. If you own gold ETFs like GLD, you still own paper. You have a claim on gold held by a custodian. You do not have gold. You have a derivative of gold. You have a promise that somewhere in a vault that you cannot visit, there is gold that belongs to you. In a real crisis, the difference between a claim on gold and physical gold in your possession is the difference between wealth and worthlessness. It is the difference between having something and hoping you have something. Let me tell you what happened to ordinary people in past currency collapses. In Weimar Germany, people who held government bonds saw those bonds become worthless. Teachers, doctors, professionals who saved their entire lives watched their savings evaporate. People who held gold preserved everything. They bought farms, they bought businesses, they rebuilt. In Venezuela, people who trusted the banking system lost everything. The bolivar went from having value to being worth less than the paper it was printed on. People who held hard assets survived. People who held dollars, gold, or real estate came through. In Argentina, time after time, people who kept savings in pesos watched those savings evaporate. The government devalued. The banks froze accounts. Savings vanished. People who held dollars, gold, or real assets came through. The pattern is the same. The outcome is the same. Only the geography changes. Japan is the canary in the coal mine. It is not different this time. The mathematics are the same. Unpayable debt eventually gets defaulted on, either explicitly through restructuring or implicitly through inflation. The only question is whether you will be on the right side of that equation or the wrong side. The only question is whether you will act on what you know or wait for permission that will never come. Here is what you need to do. I am going to give you specific steps because knowledge without action is worthless. Step 1. Convert a portion of your savings into physical gold, not paper, not ETFs, not futures contracts. Physical metal that you can hold, that has no counterparty risk, that cannot be printed, that cannot be frozen, that has been money for 5,000 years. Start now. Do not wait for the perfect entry point. The perfect entry point was 184% ago. The second best entry point is today. Step 2. Reduce your exposure to long-duration bonds, whether they are treasuries, municipals, or corporates. Long duration means more sensitivity to rising yields. A 30-year bond loses more value than a 5-year bond when yields rise the same amount. The pain in Japan is most acute in the 40-year and 20-year maturities. Learn from their mistake. Do not hold what is burning. Step 3. Understand that what is happening in Japan is coming everywhere. Developed nations have accumulated debt that cannot be repaid at any reasonable interest rate. The United States, the United Kingdom, France, Italy, all of them. The only options are default, inflation, or financial repression. All three are terrible for holders of fiat currency and government bonds. All three are bullish for gold. There is no scenario where the current trajectory continues and savers win. None. Step 4. Share this information. Subscribe to this channel, hit the notification bell, leave a comment. The algorithm suppresses this content because it challenges the narrative that keeps the system running. Every share, every like, every subscription is a small act of rebellion against a media complex that has lied to you. You know someone who needs to hear this. Send it to them. Do not wait for the market to calm down. Do not wait for volatility to subside. Do not wait for CNBC to tell you it is safe. They will never tell you it is safe to buy gold because gold is a vote of no confidence in the system they exist to protect. Their advertisers are banks, their guests are fund managers, their incentives are aligned against you. Do not tell yourself you will buy on the next dip. Every dip in gold over the past 5 years has been a higher low. The dip buyers from $2,000 thought they were getting a bargain. The dip buyers from $3,000 thought they were late. The dip buyers at $4,000 thought they missed it. Gold is now at $4,120 and climbing. The dips are not entry points. They are brief pauses on the way up. Do not trust that your government will protect you. Your government is the one issuing the debt. Your government is the one printing the money. Your government has the same structural problems as Japan, just at an earlier stage. They are not going to fix this because fixing it would require admitting they created it. The door is still open, but doors close. Japan's 40-year yield at 4% is a door closing. Gold at new records is a signal that people who understand the situation are already through that door. Smart money is not debating whether to buy gold. Smart money already owns gold. The debate is over. The trade is on. Years ago, Bill Fleckenstein sat on CNBC and told them Japan would be the first bond market to crack, and he was buying gold. They called him pathetic. Today, Japanese bonds are cracking and gold is at all-time highs. The pathetic ones were not the people buying gold. The pathetic ones were the people paid to tell you not to. The clock is ticking. The math is undeniable. The choice is yours. Those who understand history and act on it preserve their wealth. Those who wait for permission from the same people who lied to them for a decade will learn an expensive lesson. The expensive lesson is not that they were wrong. The expensive lesson is that they knew and did nothing. The window is open, but not for long. What you do in the next few weeks will determine whether you are protected when the next domino falls, or whether you are holding the bag that the smart money already passed to you. Knowledge without action is worthless. You now have the knowledge. The action is up to you. Act while you still can.